when you set out to buy a property, right, there's a million reasons to want to sell, but when you set out to buy a property, especially if you're syndicating, you're going to have a plan in mind. Real Estate Lab. All right, guys, this is our last and final chapter. We're going full cycle all the way through to selling a property. And that's what I'm going to talk about here in this last chapter, chapter 12, how, when, and how to calculate selling a property, the exit model, all that good stuff. So when you set out to buy a property, right, there's a million reasons to want to sell, but when you set out to buy a property, especially if you're syndicating, you're going to have a plan in mind. Some properties are like, I kind of want to hold this forever. But there will come times when you buy a property, for example, I bought a property for $1.3 million. It's a 20 unit, and I got an offer for $3.9 million 18 months later. And I wanted to accept it. We negotiated, didn't work out in the negotiations, but I probably would have sold at that price because that was almost 4 times what I paid for it, and it was only in 2 years, right? So there's a lot of profits to be made. There's been a lot of other instances where I bought a property, the value's gone up a ton in the last couple of years, right? And in the late 2016 to 2022, we've had just incredible price increases. So this has happened a lot where it's like you buy a property, value goes up a lot, let's sell it. As a GP, as a sponsor in a syndication, we make the most money personally when we sell properties, right? We can turn them and flip them for a big profit. Obviously, it's great in a couple ways. Our investors get to cash out, see some really big returns. They get to see kind of a proven model from you, full cycle. Hey, I bought this property, we turned it. Here's your profits from it, and then you as a sponsor get paid the most. Not the fees, not this, but you get paid the most if you do it right on the profits at the sale. So sometimes you put a 3 to 5 year plan together, but in 2 years you hit a sale price and it's like, wow, this really makes sense to sell. So I want to go through. Obviously, I can't tell you exactly when's the right or wrong time to sell. That's really such a loaded question up to the deal itself and specifically what your plans are and who your investors are. There's so many factors, but when it comes down to sell, there's a practice that I want to get you guys used to doing, and that is before you even entertain a sale, be very thorough on the numbers when you're selling a property, because there are a lot of factors that come into play, and I'll explain some of them. So I've got a net sheet here, and I am going to show you guys kind of what I use. It's a very simple sheet. There's not a lot to it, but you definitely need to utilize this when you're even pre-planning to sell a property, figuring out what price makes sense to sell it at. And it may or may not be the right time based on what you see. So over here in this left column, we've got this table. This is going to help us kind of net out what after we sell, how much money's left over. Once we pay off the loan, right? We haven't paid back our investors yet, but how much money's left over? We start there. So you're going to enter a sales price, cash on hand. A lot of people forget that they have some cash in the bank account, especially in these larger properties. So, in this particular property, we have $200,000 sitting in the bank account, or about $250,000. And so by the time we close, I'm estimating, all right, we'll have probably $200,000 in the bank account. Closing costs, pretty typical, 1% to 2%. We're going to have probably a 1% broker fee on a deal this size, $13 million. We have a disposition fee as sponsors. We're going to hold back. This is something a lot of people don't do, but you need to. After you sell a property, you have investors on it, right? So you sell a property, hold back some money in that company bank account, because the new buyer might get sent some old invoices that were from your ownership. You may have, a lawsuit from them on something that maybe you claimed was true or was not true after they get into it. A lot of times in the purchase and sale agreement you'll sign with the buyer, there will be a provision in there that says, hey, this is the limit of my liability as a seller. You can only, come after me for up to $50,000. So in that case, leave $50,000 in the account and normally there's a time period after the sale. So it's like up to 6 months. The maximum you can come after me for is $50,000 for post-closing adjustments or whatever it is. So hold back that amount of money. Your loan payoff. Talk to your bank and ask your banker. This is what you're going to email them. You're going to say, hey, I'd like to request a loan payoff estimation for a closing. If we're in June, just say for a closing in September. What would my payoff be if I were in September? Can you please detail my prepayment penalties, any fees I have, minimum interest due? A lot of people mess up because, and this depends on if you're selling your property on an assumption basis or not, right? You could sell it to a buyer and they can assume your loan, in which case there's no prepayment penalties, but you've got some different nuances that come along with the assumption, right? Do people even want to buy your property with the assumed loan? Is the loan to value too low, or is it high enough? And then if you're just going to sell it outright and let them get their new financing, you're going to pay your loan off. What are your prepayment penalties? Well, if you have a loan that's on yield maintenance, you might have some pretty darn insane prepayment penalties. I've had $6, $7, $8 million loans with $2 million prepayment penalties because of the way the interest rates were, and it was on a yield maintenance program. I've had a $600,000 prepayment penalty on a $7 million loan before that we actually paid, but it was a minimum interest due. I sold the property in 6 months, and we had 18 months of minimum interest payments on this property, so I had to pay an additional 12 payments to them at closing because I had to pay 18 months minimum interest before I could sell the property without incurring any fees. So there's all these different things. Ask your banker, look back at your loan documents and see what are your fees. Ask for an estimated loan payoff and put that amount in here. If your loan is 7.2, there may very well be a couple $100,000 in prepayment penalties that you have to pay on top of that. So there's that, and then legal fees. Obviously, it's very common. You're gonna probably spend $15,000 to $20,000 in legal fees. So after that, you're gonna get your net amount. So this is the total proceeds, total credits against that. Here is our net proceeds. After that, we're gonna take out the return of investor capital. So $3.6 million was invested to buy this deal. So we're gonna do our net proceeds minus the payback of their investors. This is the total profits that are left over after the fact. And then from there, you need to determine based on what your structure is. If you have a simple structure, like in here, just for example purposes, I have an 80-20 split. Investors get 80% of the profits after they get their money back. We as the GP get 20%, right? Maybe it was an 8 pref up to a 50-50. So you have to first make sure that they've gotten their 8 pref. If they haven't gotten their full 8 pref yet over the period of the deal, you need to deduct any accrued pref from this and then split it on whatever the split is. So you have to customize this sheet a little bit based on the structure that you structured your deal. Down here in the bottom table, we have this table for investor level returns. And so we're trying to calculate what's the investor IRR, total ROI, how long did they hold the investment, total profits, all that good stuff. And to do that, we have a table where it shows how much was invested on exactly what closing date was it invested, what were all our distributions and when were all our distributions along the way, when are we anticipating a closing date, what are our anticipated profits. This number pulls from over here, and this is obviously just us giving the investors money back. And then we have some formulas. We have an internal rate of return that utilizes these two rows. Obviously, that's how the equation works. And it gives us a 21.86 IRR and an equity multiple of 1.71, a total return of 71% over a 3-year period. It averages out to about 24% a year, and we have a cash on cash of about 9% on average over the course of this loan. So these metrics are really good because if I go in here and let's say I think I talk to a broker and they're like, you can get 11.5 for this deal. Oops, I need another 0. Well, in that case, I don't really like these returns. 13%, that's not really meeting my expectations. 13% a year over the 3-year period. My investors want more than that. Well, can I get 12 million? Right? And you're going to obviously value your property based on your cap rate and your net operating income. So you're going to look at your NOI and say, hey, my NOI divided by a 5.5 cap in this area, can I get up to 12 million, or is that only 11.2 or 11.4? Or maybe it's 13, in which case, wow, 13, those numbers look fantastic, right? These are really good returns. So we're looking at all these things, and we're making sure that before we engage with any brokers on a contract, or before we decide to list the property or put it out there, that based on all these numbers, we can actually net what we're going to net. Some people will look at it and they'll say, oh, I could sell it for 13 million. So I got 13 million minus my loan. Oh, that's 5.8 minus my investor money. oh, I'm going to have 2.2 million in profits, but really we only had 1.973 because we had all these other costs and fees, right? $427,000 in fees. So, you know, you got to be a little bit detailed with this. Make sure you account for everything and you plan for your sale properly. And then when you take it to market, I suggest working with the biggest and best broker in town. Who is the hardest broker to buy from? That's what I look at. What broker in town pushes the most deals, gets the highest prices, is always hard for you to buy from because they always get their prices bid up. That's who I like to sell with. I don't like to buy from those guys, but I like to sell from those guys or girls. You know, do your diligence, work with a good broker, a sales broker. I normally suggest doing that, not listing it yourself. If you're, especially if you're dealing with these bigger properties, do your whole call for offers, get the property bid up to a nice high price, and maximize your profits, maximize your profits, maximize your profits. You are in this business to make as much freaking money as possible. You know, don't be greedy to a point where it's going to hold you back. Don't ask for way too high of a price and then everybody gets turned off. Ask for the right price, but a good price. And honestly, guys, that's it. This is the last tool. This is the last topic. This is the end of a very fun series. I've enjoyed making this for you guys. I hope a lot of people end up getting a lot of value from this. You know, really, I have a passion for helping other people get into this business because I had a lot of people spend a lot of time, you know, mentoring me and helping me when I first got into real estate. And so it's my pleasure to be able to put this together for you guys, for you guys to come out and obviously show support and love for the content that I put out is amazing. I love doing it. And so appreciate you guys being here. Hopefully you got some value. If you did, I'd love to hear from you personally. You can always shoot me an email, david@realestatelab.com. Here to be a resource for you guys. If you ever need anything, let me know. If you have a deal you want to partner on, always happy to talk about it. And I will catch you guys soon in some more content. Thanks for watching.